Kyle not Kyle here. This week, Europe leans into regulated stablecoins. Central banks tighten their grip on digital money, and the ECB issues a warning that should be on every FX desk's radar. Welcome to 4OTC's weekly digital asset update. First up, Klarna has announced plans to launch Klarna USD, a US dollar-backed stablecoin now entering testing with a full release targeted for 2026. The company says the token will support everyday payments and cross-border transactions, providing a faster, lower-cost alternative to traditional banking rails. Next up, the European Central Bank's latest financial stability review warns that stablecoins could drain funding from Eurozone banks, especially if redemption surges occur during periods of stress. Even though their market size remains small today, the ECB has placed stablecoins firmly on its systemic risk agenda, a clear sign that digital asset liquidity is now part of the broader financial stability conversation. And finally, the Bank for International Settlements has appointed a new head of its innovation hub, reinforcing global central bank focus on CBDCs, tokenized money, and AI-driven financial infrastructure. For institutions operating across FX and payment rails, this signals that the next phase of standards and regulatory frameworks will likely be driven from the top of the central bank ecosystem. So, what's the one thing we should look closer at? Klarna's move into stablecoins is the signal to watch this week. When a global payments giant starts building its own USD-backed token for everyday and cross-border payments, it shifts stablecoins from crypto infrastructure into mainstream financial rails. If firms like Klarna begin settling flows on-chain, FX banks won't just be competing with each other, they'll be competing with entirely new payment architectures. That's the update. I'm off to check whether my weekend coffee budget is stablecoin settled yet. Catch you next week.